It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. With me in the KFG studios, two CFPs, but one's also a CPA. Josh Gregory and CPA CFP Ryan Fair.
Yeah, we're glad to have you, Ryan. Well, it's tax filing time again, and this tax season comes with a whole bunch of changes. We're going to be covering questions from the pandemic as it relates to your tax picture. Things like, when can you file? And will I have to pay tax on the unemployment benefits that I got? Those questions and more coming up on this show.
If you have a question for the show, I mean, it's all tax questions. I mean, that's it. That's what today's show is about. This is actually a two-part series that we're just going to devote to tax questions because there's so many. But we'd love to hear from you. Engage with us and ask your question. You can do so a few different ways. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. You can submit questions right there as well. But then most questions and engagement come on social media, whether that's Facebook, YouTube, Twitter, wherever. Search the Wise Money Show. Follow us there and submit questions there as well. All right, welcome back, Ryan. Glad to have you with us. I always enjoy having you in here.
I enjoy it as well, man. It's
nerding
fun.
out on taxes. So like Josh said, COVID has brought just a ton of changes. And so, Josh, here's what we're going to do, bud. We're going to try and stump Ryan.
I love that.
Okay, so here we're just going to
throw
it
that
out.
every day, though.
I want you guys to know, this is what I did yesterday. I went through the hallways of Korhorn Financial Group, and I said, all right, advisors, give me your hardest tax questions from the pandemic. And I got some doozies. And we're going to throw them at Ryan. And this is going to be a two-part series. So hang with us today, and then in a couple of weeks we're going to have Ryan back on. And I'll tell you one question, my favorite question of the pandemic with taxes. We're not hitting today. It's going to be our headliner next time. And that is, if you worked from home for part of the year, do you get to claim the home office deduction? Come back for that one, because to me, that's the biggest question of the pandemic. But let's start with an easy one, Ryan. Is that okay?
Got it, please.
Okay.
The easy one's coming.
When can you file your return? Can you file by now? What have they extended the deadlines? What are some of the rules as far as like when you can file and what the deadlines?
Yeah. So the IRS came out and said that the first day to file was actually yesterday. So February 12th was when they said the e-file systems are open for business, ready to accept your individual returns.
Normally, this is mid-January, right?
Usually
around
at
the
the
20th?
end of January. Yeah.
Well, there have been years in the past where we're waiting on the IRS to finalize some forms, when they started monkeying around with trying to help you file on a postcard. Remember that?
Yeah.
So I don't know. It seems like there's often delays because every time Congress changes a law at the last minute, they have to scramble around, not only change the forms, but change their systems and whatnot. So we'll give them a little bit of grace.
Yeah, so that's what this one's all about. This is probably at least 2 weeks later than normal opening days of filing season. But yeah, Congress passed all this stuff on December 27th, and so that leaves the IRS scrambling to try to, like Josh said, update forms. The majority of taxpayers e-file, so they have to get all their computer systems reprogrammed to account for these new stimulus payments. They have to send out postcards telling everyone how much their stimulus payments were for their tax filing purposes, and there's a whole bunch of logistics that are pushing this back.
So what are they doing with the deadlines then?
So
I mean, could change at any moment.
Yeah, who knows? I personally think this might have been the precursor to them pushing back the April 15th.
Really?
Like permanently?
No, not permanently, but for this year again. Yeah. But as of right now, everything is still set for normal filing deadlines. So S corps and partnerships are still going to be due March 15th. all of our individual tax filers filing their 1040s. Those are set for April 15th still at this point.
But by the time you listen to this, that may have changed.
Yeah.
Who knows? That'd be another reason to stay connected with us on Facebook and YouTube and all that. We'll deliver all those changes as they happen. As the virus continues to spread, and yet the vaccine doesn't at the moment. Some people are wondering how to get their taxes done in a COVID kind of germy world. I am absolutely pumped by the new system that we have here. Just Ryan, really quick before we get into questions, for anyone who's saying, okay, well, I know that I can start filing my return now. How do I do it with as limited human-to-human interaction as possible?
Yeah. So first of all, I never dreamed at this point, a year ago, that we would still be talking about COVID. I thought it was going to be in and out and over in a few months. The 2 weeks to slow the spread, and then it would kind of die down. Anyways, that's really forced us to change a lot of our systems and the stuff that we have available for taxpayers. With the shutdown last tax season, it forced us to really learn a lot of how we deal with clients remotely. It really scrambled to change a lot of our systems and accommodate the shutdown last tax season.
During tax season, during the middle of tax season.
Right in the middle, yeah. And so this year, prior to the pandemic, we were comfortable with Zoom. We used Zoom frequently for dealing with clients that were out of town to help, talk through situations, meet with them virtually. We really hadn't used it when we're meeting locally with people across town instead of across the country. We got really good at that last year and still continue to do that. And then, as information gathering, so everything is still paper for the majority of taxpayers, where they receive their W-2s via paper. They receive all their mortgage interest, their bank statement, their interest. All of that stuff is paper for filing. And for clients as well as employees, they were kind of, hesitant of passing off all this paper and bringing paper printed returns back home. So this tax season, this off season, we found a new software that they've been around for a lot of years, but it's new to us. It's called Tax Caddy. And what it is it's an app in a computer, internet-based program where clients can upload all of their information to us very easily right on their cell phones.
Yep.
So they can take pictures of their forms. It comes straight to us. They can answer all of the questions that we ask them every year. They can sit there and click yes and no on their on their questionnaire at their convenience. So they could be, sitting in line somewhere, waiting to check out or wherever, and answer all their questions. It's super easy.
Yeah. One of the questions that a lot of people have wrestled with in recent years is whether or not they even need a paper copy of a tax return. Do I have to have it physically in my file system in the basement or whatever? I'm hearing more and more people actually eager to purge those files, those filing cabinets and everything, and they're often asking, well, how many years do I need to keep?
Yep.
Right? And do they even need to be a paper copy?
Right.
Can they be a PDF now? Especially knowing that your CPA also has a copy at any time that you could tap into.
Yeah, the IRS has embraced all of the cloud storage for taxpayers. So you don't have to have physical receipts, physical copies of your tax returns and W-2s. That stuff can be scanned and saved digitally, and that is effective or good enough for the IRS if there was ever an audit or a need to review something. So I personally, that's the only way I do my stuff. I don't keep paper copies of everything in my file cabinet. It's funny, every year when I'm meeting with clients, I hear these questions. Well, we got married back in 1966, and I've got every copy since. Do you think I can get rid of any of them? And the answer is yes. If you feel inclined to keep paper copies of any of that, the longest period that I always tell people is 7 years. That's kind of the safe and easy answer.
But if everything's digital and we're switching to a more digital platform anyway, that's good. I was thrilled when I was taking pictures of my W-2 and stuff and 1099s, uploading it. It's pretty sweet. So
cool.
More and more questions coming up right here on Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. My name is Mike Bernard. You are watching our 1 hour talk show that airs right here on this channel every Saturday at 10 a.m. Also airs on podcasts. So if you're into that, go check that out wherever you listen to podcasts. If you're not a subscriber, hit that subscribe button, turn on notifications, and smash that thumbs up button. Notifications are important because even though this show airs every Saturday, we also post lots of other content throughout the week that you're going to want to take advantage of. So turn on notifications as well. Hit that subscribe button. If you like the content, smash that thumbs up button as well. Thank you.
Sorry, I went a little long there.
That's all right.
You got excited about
I did.
the new client experience.
Yeah.
I'm excited about it.
So I took pictures. Like, I've tested the whole thing. Like, I took pictures of 3 documents. I uploaded a few other documents on my actual computer.
Yep.
The only snafu that I had was one of them was still a JPEG, and I needed to turn it into a PDF, which on a Mac is really easy. And
A Mac.
PC,
what's
it's
that?
not very easy. So
Jeez.
It's nearly impossible on a PC.
nearly impossible.
Just print it
So-
out and take a picture of it. It's easy.
And then that works. So no, it's stinking sweet. It'll be great to see how filing returns works. All right, here we go. So we're going to start with that stimulus question, and there's going to be several. Like, we're not going to hit all these in the second segment.
Okay.
So, is your stimulus check taxable? What about the additional pandemic unemployment assistance? All sorts of tax questions. We're playing Stump the CPA today. Ryan Fair with us. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory, and like I said, special guest CPA Ryan Fair. If you have any questions, we'd love to hear from you. Engage with us online, wisemoneyshow.com, and then all over social media, wherever you're at. We are there as well. Search the Wise Money Show. Engage with us there and submit questions there as well. Okay, Ryan, I was, this is a couple weeks ago, inauguration. It's really funny. I was watching some comments about the inauguration, which is, that'll put you in a bad mood. Like, on both sides, people just mean and whatever. I did have, the funniest one was someone said, man, this party looks pretty fancy for someone that owes me $2,000. I thought was hilarious. So anyway, okay, so all the stimulus, right? All the stimulus. This has been interwoven with taxes, and most people don't realize it. So is this stimulus money, is it taxable?
So good news, no, none of the stimulus money that you've received is taxable. And I'm talking about specifically the stimulus. So something else that you threw in there was unemployment.
We'll get there next.
Okay,
We'll get there
okay.
next. Let's just talk about that helicopter money, that direct payment, that $1,200, that $600, that
I was going to say, you keep
$1,400.
referring to this like singular. These are a series of checks at this point.
Unbelievable.
It's your stimulus salary at this point. My goodness, it just keeps coming.
Okay, so not taxable.
Not taxable.
Okay. So, so the way they get around that, just to geek out, it's a tax credit.
Right.
So like, let's then get into the minutia for just a second. Say, it was a stimulus payment paid to you based on your last filed return. So for most people, that was 19.
Yep.
What if you didn't qualify in 19, but you qualify in 20?
So yeah, if you didn't qualify for some reason in 19, most likely because your income was too high, but your income dipped back down below the limits for 2020, you will get your stimulus payment on your tax return as a tax credit.
As a tax credit. And like always, tax credits are not taxable. So that's how they get around this.
Yep.
So then what about this one? I had a child in 2020. They weren't a dependent on my 2019, but they are in 2020.
That's a good question.
Everyone's talking about getting $600 or $500 for these kids, and I'm buying diapers.
Yeah.
And I'm not getting money.
So good news again on that one. So all of the stimulus payments received so far have been prepayments of 2020 tax credits. So if you had a new child in 2020, you actually will get both stimulus credits for the child, meaning the $500 and the $600. So you will get an $1,100 credit on your 2020 tax return for that child.
And you still get the normal tax credit for children, right?
$2,000.
Children under age 17, couple grand a piece.
Yeah.
Man,
So
I hope you tuck that child into 2020 instead of 2021.
Yeah.
If you had that baby on
January
January 1st.
Wow,
Oh, come on, honey.
that is terrible timing.
Okay, so what about the opposite here? You know, one of my biggest complaints about this stimulus has been the children left behind.
Yeah.
No child left behind. No, folks, we've got children left behind. If they're age 17, if they're a dependent of yours, but age 17 or older, nada. They haven't gotten anything. So they're age 16 in 2019. Mm-hmm. They turned 17 in 2020. Did the IRS system, did they know that? Are they going to take your stimulus back?
No. So they're not going to be taking the stimulus money back, which is, interesting. Obviously, it's good for taxpayers, not good for the government as far as money going out. But no, they're not going to be taking the money back if they've received the.
And it doesn't become taxable if it turns out that you really weren't eligible for this.
Right.
You got the advance check, and it's not something that gets counted on your tax return. It's not like that becomes taxable income for you either. So if you got the money, you got the money.
Yep.
If you're thinking, hey, this is so awesome, go to worlddebtclock.org. Okay, so unemployment. Now this is a different story.
Yeah.
I think if I could make a prediction, I did hear on the program a couple weeks ago saying that we're going to have a retirement boom. Everyone agreed with me. If I were to make a prediction this year, it will be a wailing and gnashing of teeth around taxation of unemployment.
Yeah.
Is unemployment taxable? And what about the extra pandemic assistance amount, the extra $600 a week, the extra $300 a week, the extra $400 a week?
All taxable, Mike. So yeah, I'm some people use those plastic barriers for virus protection. I'm going to use them for security for the angry clients that want to jump across the table at me this year. But no, that stuff is all taxable. So unemployment, whether it's regular unemployment, the bonus unemployment, whatever you want to call it, that stuff is all taxable this year. So hopefully, a lot of people do withhold from their unemployment checks, but it's only 10% usually on the federal side.
10%,
which is not enough.
And you said a lot of people. We work with a weird segment of the population because people, are more aware, more attentive. I don't think most people.
Yeah, you're probably right.
I mean, because logic, and that's your first mistake. Don't use logic when trying to understand government and taxes and everything. But logic would say this is unemployment. The government is giving me money for aid. Yeah. Why would I have to give some of it back? So
well, and there are some states around the country that do not make you count all of this, or maybe don't even make you count any of it. Of course, there's some states that don't even have a state income tax, so it wouldn't apply there. But if you're listening to this and you're outside of Indiana, Michigan, Illinois, Ohio, which is kind of our backyard, you need to look at your own individual state to just make sure that it's not already counted. But I would make sure that you're planning ahead, especially on that federal level, because that's the heavier tax bite. It's going to be counted, and it surprises people all the time. It's just that in this environment, in 2020, there's literally millions of people that have gotten this unemployment, never gotten it before in their life, and now they potentially are going to be surprised.
And just fact check here, I said World Debt Clock, and no, it's usdebtclock.org if you want to know. So we all have about $85,000 of debt per citizen. Like that's what we owe. It's crazy. So, okay, what about they changed some of the rules with required minimum distribution.
Yeah.
And so, Josh, I don't know if you want to speak into some of those rules, but if someone took it out and then put it back in after the rule change, how does that account on their taxes?
Well, yeah, so let's define required minimum distributions real quick because it's a phrase that we use on the show a lot. If it applies to you, you probably know it. But essentially, once you reach a certain age, and it's now age 72, you have to begin drawing out of your retirement accounts. And that's because the government wants to tax you on this money. Also, if you inherit money in an IRA or another retirement account, you will be forced over time to start pulling money out of those accounts as well. It's just that the rules got all shaken up last year. Mm-hmm. They had already been shaken up because of the Secure Act at the end of 2019, and then 2020 comes around and we got a pandemic, and suddenly they give you the year off. But maybe you didn't take the year off.
All right.
Still taxable to you, whether you took it, if you did take the money out. But many people, they passed. They didn't have to take it in 2020.
And if you put it back in.
Right. Then that was something new that they allowed this year, where they allow you to put it back in, and it is treated more like a rollover, so it's not taxable in those cases.
And they gave you a little bit more time. Normally that's
right.
a 60-day rollover. They gave you a little bit more time. I've got several others here about when our estimates due, living in one state, working from home, PPP for all of you small businesses. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Cool. Actually did a commercial about PPP per the request of MNC. So basically not giving the answer away, but saying if you qualify, you should still be able to count the expenses as deductions.
Yeah.
But this underscores the reason you need a professional. So give us a call is basically what I said.
So it was part public service announcement, part advertising.
Yeah.
That's cool.
All right. You know about how they're going to do withholdings on these coronavirus-related distributions? So he took 100 out.
I don't.
I withheld 20. So should we sidestep that until we?
I mean, so the withholdings part, I don't know specifically. Like, I know you can prorate the distribution over 3 years.
And I'm assuming you prorate the withholdings too. But, right?
How would that work?
Exactly.
I know.
We'll see. We'll see how it all pans out as we start doing returns. But so I'm not going to throw that question in here because that'll just.
That's fine with me.
I think we still at least need to recognize, though, the whole 3 year.
Yeah. So you can't.
Do you pay it back during the 3 years, and now you got to go back and amend a bunch of returns, or at least the 2020 return?
Okay, so my guess is this goes with questions all 4 segments. So we'll just keep going. We'll go coronavirus related distribution, paying estimates. This. Oh, you had one. What was it?
The homeschool versus stay at home school.
Oh.
Yeah, we're gonna hit that one too. Hey, my kid did virtual learning. Do I get a homeschool deduction?
Oh.
Ryan, you're such a jerk.
I know.
All right. Did you have any of those kiddos doing virtual learning or homeschool? Do you get a homeschool deduction? Interesting question.
Yeah.
Let's see if we still like Ryan or not. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFC studios, Josh Gregory, and yes, CPA Ryan Fair. We're trying to stump him today, asking him all of the most important tax questions related to the pandemic. And folks, there's so many. We're doing 2 shows. This is our first part of a 2-part series on the greatest tax questions from the pandemic. If you've missed anything thus far, every episode of the Wise Money Show is on podcast, so go check it out wherever you listen to podcasts. Search the Wise Money Show. When you do so, rate the show. We appreciate that. Give us a rating and leave some feedback there. Leave a comment. We appreciate that. All right, let's keep going here. So you heard last year about this crazy thing called the coronavirus. And then the IRS latched onto it and said, we're going to make this, coronavirus-related distribution. And what that means is you could, if you had COVID or your spouse had COVID or you were adversely financially impacted, which was pretty much all of us. No, your hours were cut or you lost your job or whatever.
Had to quarantine.
Had to quarantine, right? Any of those 3 criteria, then you were eligible to withdraw up to $100,000 out of your retirement account and say, oh, well, whoop-de-doo, thanks. Well, there's a couple cool features. Number one, if you were not age 59 and a half and supposed to pay a 10% penalty, that penalty was waived. Mm-hmm. Awesome. It's still taxable money, But then that kind of gets to part two, and you can choose to stretch the taxation of that money over 3 years, 2020, 21, and 22. So now it gets to tax time. And how do you know, Ryan? How does someone know how this is taxed, or is it automatically like are you going to how does a coronavirus related distribution show up on the return?
Yeah, that's a great question, Mike. So stump the CPA, is that what you called this? No.
It's going to show up you're going to get a 1099.
Right, you're going to get a 1099-R that shows a retirement plan distribution. I believe there's going to be a separate code that distinguishes that this was a coronavirus-related distribution, or part of it was. And at that time, I believe the taxpayers have the option where they can elect to have it taxed over a 3-year period, as opposed to all being taxable in 1 year.
Is that the default, by the way, like that it's going to be spread out over 3 years? Or is the default, you took it in 2020, it's going to be counted in 2020, all taxed, everything in the year that you took it?
I believe that the default will be taxable in 2020 unless you elect to stretch it out over 3 years.
Yeah,
okay.
Interesting.
I did read something that said it does need to be coded the right way as a coronavirus-related distribution. That's some jargon. That's an official term, as opposed to, in years past, there was always this option of taking a hardship withdrawal.
Right.
And a hardship withdrawal is not eligible for the same, prorating and payback rules and all that. So, boy, I sure hope that it got coded correctly when you took that distribution.
I mean, here's the thing. So we've got Ryan's a CPA. We've got a full team of tax preparers, CPAs, and we always talk, and Wise Money Show is talking about planning. It's talking about comprehensive financial planning. Tax planning is part of this. But the reason, especially this year, you need a pro doing your taxes is how are you going to make this election? And then there is another ace up the sleeve with this thing. If you took a coronavirus-related distribution and you want to pay it back, you realize, I actually didn't need that money. You have up to 3 years to do that, and then you amend your returns. So work with a pro this year. I mean, we can't help everyone, so reach out to a CPA. If you would like our help, you can find us online, corehorn.com or wisemoneyshow.com, but work with a pro.
You know what? I would go even further and say that even more strongly, that if you were involved in any way with a coronavirus distribution, or someone in your family passed away after doing that, I would just plan on the next 3 years at least working with a CPA, because the decision making and your ability to kind of unwind some of the choices that were made, there may be some really big planning opportunities here if you're paying attention.
All right, we got to get to business owners quickly, but I want to sneak a question in here first. So my kids did e-learning or virtual learning for a chunk of last spring. We sent them to school this fall. They've each had to quarantine a lot. Thankfully, they haven't had it yet, but they've been close contacts. So all these parents have this burden of doing this schooling stuff from home. Do they get a homeschool deduction?
Well, Mike, congratulations. No, you don't.
Oh, Ryan.
Yeah, good effort, but no. So what you're referring to in Indiana, we have a separate tax deduction of $1,000 if you have, it's per child for homeschool or private school education. And if you are still enrolled in public schools but doing virtual, that does not count as homeschool.
And the reason why is when, especially Kuiper was the first one that was a close contact. And when we got that news, they gave him his tote, and he brought all of his materials home. The reason you get the deduction if you're homeschooling is you've got to buy your own materials.
Right.
There are expenses there. With public school, even, when they send the kiddos home for virtual learning, they're going to send you. I mean, you certainly probably had some expenses, sure. But that's your justification. Let's start talking to you small business owners. And before we get into the PPP, what about estimates? Most small business owners pay estimates, but a lot of individuals do as well. Last year, with the when someone files their return and they tell you, hey, these are the estimates I paid or I didn't pay, there typically can be penalties if you didn't pay them on time. When were they due last year?
Yeah, so last year with the extended original tax filing deadline, they also extended the estimated tax deadlines. And so first and second quarter we're both due July 15th of 2020.
Okay.
Third quarter remained the same, so that was September 15th, 2020. And then fourth quarter also remained the same, January 15th of 2021.
So
I had some clients who were paying quarterly estimates for the very first time last year. And, we come to April 15th. Oh, you don't have to pay.
Yeah.
June 15th, that's the normal date. You don't have to pay.
Right.
And that's good because they had forgotten, actually. Yeah. They hadn't gotten into that habit yet, and July 15th kind of bailed them out. But don't plan on that for this year.
Right.
Right? You got to be ready for your normal. Everything goes back to normal until they change it again.
Yep.
Right?
if you are a small business owner and you did not receive the PPP loan, you're going to want to talk to a financial professional about it. And there is PPP round 2. It's more strict in who will qualify, but talk to a professional about it. If you did receive it, though, you've got to be working with a qualified CPA firm.
Yeah.
The taxation of this money has been an absolute nightmare. It's been just all sorts of drama. Really quick, Ryan, in 30 seconds, what would you say about the taxability of PPP forgiveness?
Yeah, long story short, the PPP forgiveness is not taxable as long as you used it for the qualified expenses, which were primarily payroll, mortgage interest, rent, those few qualified expenses. So it's not taxable, and you get to use those expenses just like normal that you were paying for payroll expenses. You can deduct those just like any other year.
So you get the tax write-off without having to count it as income, in other words.
That's correct.
Double whammy in your favor.
In your favor. And, I remember Mother's Day driving to go pick up dinner for Cindy, hearing the drama that, no, this money's going to be taxable.
Right.
No, at that time, the money's you're going to have to pay it all back.
Right.
You don't even get this. Most businesses don't get it. And then, no, it's going to be taxable. No, they're not going to let you use these deductions. It's been all sorts of drama, but good news. Work with your CPA if you've got the PPP. All right, we've got more Stump the CPA coming up on a Wise Money Show with Korhorn Financial Group. All right. Let's, is there more we want to talk about and explain about the PPP, or do we just go into tax questions?
I think getting into questions would be good.
Okay. So let's start with the, I work in one state, live in another. Yeah. I switched states, or I switched jobs during the year, and then capital gains on my investments. So those are two we'll hit for sure.
What was the question about capital gains on investments?
Just someone's shocked that they're there.
Oh.
So it's just basic. But we can get into tax rates and, short-term, long-term, losses.
You could just be the bearer of bad news.
Yes.
Isn't that your favorite role as a CPA?
That's close to my only role.
And then there's a question down here in December from Jean, and I'll tell people I got back to her. So it's a dated question, but it's good to still hit.
Okay.
So that we can explain how that all works. So we'll do those 3 questions, assuming we've got enough time.
Where's the question from Jean?
1216 text from Jean.
Oh, gotcha.
I already got back with her, and we've texted back and forth several times. Oh, no. Let's do Brinkley's question. I got back to Brinkley as well. Let's see what your answer is.
I don't have any of the questions, so I'm shooting from the hip. So you might truly stump the CPA.
All right. Here we go.
Oh, we can send you the link, too.
Nope. No.
Ryan, I got your back.
You live in one state, you work in another. How in the world do those taxes shake out? We're gonna ask Ryan Fair, CFP and CPA, that question coming up. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here, friends. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory, and special guest Ryan Fair. Every episode of the Wise Money Show is on our YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it, turn on notifications as well, because this full 1 hour talk show isn't the only thing that airs on that channel. We also have daily financial nuggets, next wise steps, we call them, that show up every single business day. So check that out. Go to YouTube, search the Wise Money Show, subscribe to it, turn on notifications. All right, we've been playing Stump the CPA with pandemic-related tax questions, Ryan. We're shifting gears away from pandemic-related questions just to normal tax questions from fans of the show.
Thanks.
Yeah, you're welcome. And just so you know, I had shared the earlier questions with Ryan before the program, but these questions I was intentionally hiding from him until Josh just got too nice, and I think Josh sent him the link.
He did.
Yeah.
I wanted to see Ryan squirm.
Yeah.
All right, we'll see. Okay, first question was texted in. It's not from an individual. We don't have their name, but here was the question. I live in one state, but I switched jobs this year and started working in a different state. How does that work on my taxes?
Yeah, good question. Typically you pay state income tax to the state that you live in. So for retired clients, for example, if they live in Indiana and, all of their income is taxable to Indiana. If you are working in another state, most other states want you to pay income tax on that income to their state. Indiana has special agreements with a few states. Michigan is obviously our closest neighbor that we deal with. It's called a reciprocal agreement, where Indiana and Michigan agree not to tax each other's income at the state level. So if you live in Indiana, work in Michigan, Michigan says, okay, Indiana, you take the tax on that. We won't charge anything to your client. The reverse, though, is confusing. If you live in Indiana or live in Michigan, work in Indiana, the states have the agreement. However, Indiana has this county income tax where Michigan residents still have to pay the county tax to Indiana, not the state level, but the county. And then what makes it even more confusing is they get a credit then on their Michigan tax return for taxes paid to another state or government entity.
I tell you what, when we get to know new clients for the very first time and we start investigating their tax picture, sometimes we stumble upon mistakes made in the past because of this very issue.
Yeah.
Right? Not coordinating the 2 years quite right. Or the two states, rather.
Yeah, this is by far, I'd say probably the most common mistake that we see with taxpayers that self-prepare their own returns. Last year it was great because we had a individual from a company that had self-prepared TurboTax their return, and we've caught this mistake. He went back to his coworkers, 7 or 8, there's at least 7, 8, 10 of the coworkers scheduled appointments with me, and we went back and amended 3 or 4 years worth of state returns and got back thousands and thousands of dollars for these guys. It was awesome.
Yeah.
So
that's the kind of news you like to deliver, right?
Exactly.
Hey, we found a mistake and a solution for you.
Exactly.
We found a mistake in your favor.
That's right.
And so, our office, we've got an office in Niles, we've got an office in Granger, we've got an office in Napanee, we've got an office in Walkerton. And so we are in the Michiana area, so we see this a lot.
Right.
If you self-prepare or if you're working with someone who does taxes out of their house, they're likely going to miss this.
Yeah. Another scenario that's becoming more and more prevalent is you work from home. Maybe you work virtually. Maybe you're a salesperson for a company that's located in a different state, but you work out of your house here in Indiana or Michigan or whatever. And another mistake that sometimes happens corporately by employers is they just default to withholding the taxes for their own state. Mm-hmm. I've got clients who work for Virginia companies, and the employer just won't stop withholding Virginia taxes only.
Right.
And it can create some issues on the Indiana return for this client.
Yeah, they would owe, big Indiana income tax, which would most likely include some penalties and interest for not paying in throughout the year. And then the client then is required to file a Virginia tax return to get 100% of that withholdings back, because they never owed any tax to Virginia. They didn't work or live in Virginia in that example. So, yeah.
So
Right.
in this day and age when you get your paycheck stubs sent to you digitally, maybe
yeah.
you don't review it like you once did. You don't really kind of scrutinize those details. But this is part of the reason to have a financial advisor in your life, to have a CPA that collaborates, someone who's got extra eyes on this scenario to try to catch those things early on so it doesn't become a problem for you.
One of the investment themes for 2020, and we still can't tell, and it probably doesn't really matter, but there's been a lot of attention drawn on folks that are brand new investors. And brand new investors have taken stimulus money or taken a little extra of their unemployment, and they've thrown it into the stock market using these really cheap apps. Robinhood is one of them, probably the most well known. And they're buying stocks. And let me just geek out on you for a second. How do I know this, or why is there this speculation? The cheaper the stock price, the better it has performed. And you might say, well, that makes sense. No. The stock price has nothing to do with the value of the company. Mm-hmm. The stock price has to do with how many shares are outstanding. And so much so that shares of companies that their stock trades at $1 or less have performed twice as good as companies whose stock shares trade at $2 to $1. That's performed better than stocks that are priced at $10, perform better than stocks priced at $25. It's unbelievable.
That's crazy.
And that suggests that people are just taking $20 and throwing it into an app and saying, all right, well, what can I buy? Let me buy some stock. What they don't realize, number one, they don't realize there's risk in the stock market, and we'll all feel that again at some point. But the second thing they don't realize is the taxes that come with all this buying and selling. So I got a question here. Do I really have to pay all this tax on these gains in my investments? How does this even work?
Yes. So here's your wake-up call. Get ready, because if you were doing kind of the day trading approach where you were buying and selling, and short term, which it doesn't have to be a day, but short term is considered less than a year for IRS purposes. And any capital gains, so anything that you sell the stock for higher than what you paid for it, is taxed as ordinary income. So that's going to be included on your tax return as income, just like your W-2 or interest from the bank.
Except nothing's going to be withheld against it.
Exactly.
Right.
And so all of a sudden you made $3,000 or $4,000, and that lands on your tax return, and nothing has been withheld on it.
Yep.
So that gets caught on the tax return, and that's when the tax gets calculated. That's when you've got to pay. And if you didn't withhold enough taxes from your paycheck or some other source, you're going to owe that money come tax filing time. And if you owe too much, you could even have penalties thrown on top of that.
Okay, so let me stump you, Ryan.
Okay.
You got short-term capital gains and long-term capital gains.
Yep.
I think last year was the year of possibly speculation, people doubting the rally all along the way. So it starts going up, I'm going to sell. So we got a lot of short-term gains. Those short-term gains are taxed at what rate?
Ordinary income.
What if you were actually in the 10 or 12% tax bracket, but you sold something at short term versus if you just held it for long term?
Yeah, so if you sold it while it was short term, it's taxed at that 12% or whatever tax bracket you're in. If you would have waited a little bit longer and held the stock longer so that it was held over 1 year and had long-term capital gains, all of that capital gains would have been taxed in the 0% tax bracket on the federal return.
That's right. That's right. Because long-term capital gains,
Right.
It's 0% or 15% or 20%, right? And until it all changes,
Yep.
like they're gonna.
This is also a good example of places in the tax code where the IRS gives you some goodies, some sort of tax breaks that the state doesn't also give you.
Correct.
Quite often, the state's just going to tax you at your normal rate. In Indiana, for example, it's pretty much a flat tax that you pay to the state. So just keep that in mind, that even if you play your cards right and you're able to avoid some tax at the federal level, you're not avoiding it at the state.
Correct. Yep. It's income is income on the state level in most cases. So
We haven't even talked about, the big questions with the pandemic related to charitable contributions. And
yeah.
we've done a couple shows on that. So if you were really hoping to hear some comments about that, you'll just go to the YouTube channel, check it out. But we've got a question from Brinkley here that was texted in, and she said, I made a donation to my church, which is they're a nonprofit, and they've got all the nonprofit tax ID number, whatever. The contribution I did through a bank transfer, ACH, and it happened at the end of December, and yet for some reason the money didn't show up in the church's bank account until January 4th. Brinkley, how do you know that? That is my question, because I texted with Brinkley about this, but I never asked her, how do you know it didn't show up in the church's bank account to the 4th? But anyway, say that's all legit.
Yep.
When does that count on your taxes?
Yeah, so all of us individuals, when we file our tax returns, you're considered a cash basis taxpayer, which means you deduct it when it leaves your possession. So I would say that's a 2020 tax deduction. If it left her account on December 31st, let's deduct it on your 2020 tax return. Now, you just have to be honest and remember that when your church sends you your 2021 giving statement that shows this deduction that you already took on the prior year tax return, you don't want to double deduct it.
Yeah, that's a good point.
Well, you don't. Yes, you want to.
Well, yes,
but you should not.
Yeah, you shouldn't.
It kind of negates the charitable or the church gift if you're doing it fraudulently double deducted. Okay,
so if yeah, that's right. But I donate to the church, so that covers me for this.
Yeah.
Okay. That's what if you wrote a check?
Same thing.
What if the check hasn't been cashed though? You wrote the check, you just haven't seen the money pull. I'm trying to stump you in the last minute here.
I say deduct it.
Yeah?
Let's deduct it. No, if it truly left your account, if you put it in the mail, it's out of your control at that point. The gift is completed from your standpoint as a taxpayer. So I would deduct it.
Yeah. I would agree. And there are, you have a special $300 deduction for cash contributions to a nonprofit. There's other special deduction rules for last year for 2020 on, gifting a certain amount of your adjusted gross income. Work with your CPA. Ryan's not half bad. Work with Ryan or work with a CPA. Get some help. So, all right, that's all the time we have for today. On behalf of Josh Gregory, Ryan Fair, all of us at KFG, have a great weekend. See you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.